I'll start with a quick review for this book, or course. I'll refer this as a book, The Art of Investing by the Great Courses, Lesson from History's Greatest Traders. So I'll give this book 3 out of 5. There is some good information, but I felt like there is more emphasis on the stories and on the people themselves than what they were doing. And also there is too little emphasis on the actual ideas and how their strategy exactly worked. So more about what they were doing instead of how the underlying system worked. I think you could do more about that. Let's see the notes. First one is, according to one, market is like a pendulum, swinging between optimism to pessimism. So that's what markets essentially is: too much optimism, too much pessimism. That's one. Buffett's strategy was buying cheap and selling or holding forever. That's what Buffett was doing and still is doing. He always said that his best strategy is holding forever, and usually he's buying cheap. Turned out there is like a downturn or a meltdown, he always buys stocks. In 2008 he bought a lot and he just hold it. Companies tend to have a growth phase and then reach a stability with lower growth. So after a little while, it's just the growth cannot be sustained for a long time, and there is a slower growth and lower growth when the company gets too big. $1 today worth more than in the future, since it can accumulate interest. There's always the question, is dollar today worth more than in the future? The reason is today is that you can accumulate interest, compound interest. The risk is abbreviated as beta. That's usually how you abbreviate risk. Value stocks tend to overperform growth stocks since they are beaten down already. You can't get hurt if you fall from the basement. So that's why they don't get beat down, because they're already down, value stocks. And I like this phrase, is you can get hurt if you fall down from the basement. That's the idea, is that you can fall too far. And if you fall, it's not too far. It doesn't hurt. The home country bias is investing in stocks in our own countries. Apparently most people invest, and most of the money they invest, it's their own countries. Sometimes it's because they know more about it, or at least they think they know more about it. That's why it's a bias. Good company is not necessarily a good investment. That's a really good point here, that sometimes we see a good company we like, and we think it's a good investment, but this is not how it works. Sovereign funds are funds controlled by nations, usually to offset currency differences or invest. That's what sovereign funds are. There's more and more of them these days. And usually what they do is to offset currency differences, so they have control over it, or to invest. So that's one part. Let's see the second part here. Banks now leverage around 15 to 1. That is lending $15 for every dollar that is kept in the safe. Before that, it used to be 30 to 1. So that's how it works. So what they leverage is, let's say they got money from the bank, and someone put money in the bank, so they lend $15 for every dollar they save. So basically, if someone deposited $16, 15 would be kept. 15 would be lent on, and 1 would be kept. It used to be 30 to 1, so they only had $1 for every 30 in the bank, in the safe. And after the financial crisis, it reduced to 15. I think it used to be 10, and now it's 15. It's interesting to see how it works. Value trap is when a value stock is not gaining steam and often lose more value. That's a value trap, because it happens when there is a value. You think it might go up, but it just keeps going down. It's sinking. Shorts is done by selling high and buying low, but the sell is lending. So that's what shorts are. You buy high, you sell low. You sell high, you buy low. How you sell, that's the thing. How you sell is you lend. You take something, you sell it high, and then you buy it later. Momentum trading is the tendency of market to go higher when the stock goes high and lower when lower. So that's momentum trading. If there is people who do that, is when the market goes up, you buy, and your market goes low, you sell, and you just go with what the market does. Being able to change your perspective 180 degrees is important for investment or investing, because you have to change your view. Sometimes things are changing rapidly, and if you keep getting stuck and you're not changing your views, you're losing. Quants or quantitative analysis are using past data to determine the value. That's what quants are, which is quantitative. They use quantitative information such as past data, and that's how they determine the value of the stock, worth or not. One of the disadvantages of high frequency trading is best seeing where one company lost $150 million in 45 minutes due to a mistake. What happened there? High frequency trading is trading on small differences in time, in arbitrage. It's about computers doing all the work. It's very small differences between the prices of stocks. What happened is, when there is a mistake, one company lost almost $500 million in 45 minutes because there was a bug in the algorithm, and they lost a lot of money. And the last one here is going private, usually funded by debt, 3 to 4 times the investment. That's why going private, they take about 3 to 4 times the money they invest. Let's say they invested $10,000, they take $30 to $40,000 on that investment. So they use leverage to go private. So that's for the notes. Again, some interesting ideas, especially if you're not well versed in the investment industry. And some interesting ideas, but overall it wasn't the best. So that's why 3 stars. Thank you.